A very good evening to everybody. My name is Amber, and on behalf of ASK IM, let me welcome you all to our quarterly knowledge series initiative on ASK products and portfolios. Today we have with us Mr. Kuldeep Gangwar to discuss on ASK India Vision portfolio. Kuldeep has joined ASK 5 years back, and he carries a rich industry experience of 17 years as research analyst. Prior to ASK, his earlier assignments were with HSBC Securities, Capital India Limited, and Tata Motors. He is a BTech from IIT Roorkee and MBA from IIT Bombay. He is also a CFA chartered holder. So let me welcome Mr. Kuldeep Gangwar. He will take the discussion forward with an overview of Indian economy and key aspects of ASK India Vision portfolio, followed with a Q&A session. If you have any question, I'll request you to please type your queries in the chat box to help us addressing the same, right? Over to you, Kuldeep.
Thanks everyone and welcome to all of you. So before getting into say portfolio details, it always is the case that in which macro environment we are working. So as it had been the case in past, like the global situation first. So as you will recall that from September 21 onwards, the things were only getting worse till March 23. And only from April 23 onwards, we are getting a situation that we can say probably the worst is behind. Like in April 23, RBI took the pause on interest rate hike. As far as Fed is being concerned, probably they have come quite close to say hike in interest rate cycle. Though inflation risk persists, but it's trending downwards. And our understanding is that probably next year onwards, we should be discussing that when the interest rate will be coming down. So net, we can say that from inflation scenario, interest rate scenario perspective, worst is behind. It's at the margin, neutral sort of situation as we speak. Commodity scenario, last 1 year, there had been significant correction from the peak, like oil made its peak in February 22. And since then, we can say that oil is down close to 12%. So is the case with many other metals and agri commodities. So if we think from say February 22 peak, it's quite visible that it's down 33% as we speak. Supply chains are also normalizing. So during the COVID time, there had been a lot of disruption, which led to a situation that freight rates had moved quite northward and which resulted in higher OPEX for the most of the company. Now it has come down probably to the pre-COVID level and no more a concern going forward. Food index has also come down from its peak, though a long way to go. So global macro perspective, I would say the things are relatively more stable as we speak, and hopefully things should remain stable even for quarters to come. If we think about global macro situation, it's relatively better that and it has more to do with the capex we are doing on ground, like almost 9% growth in cement, 10% plus on the steel side. It just suggests that the on-ground activities are pretty good. As I have already mentioned that the input cost, commodity costs are coming down, it's also helping in the margin expansion for the most of the end user industries. There had been some concerns related to the export related sector, whether it's a chemical or say pharma to some extent. It had more to do with that there had been some say concerns related to China slowdown. If it would be the case, then it would be having downward pressure on the most of the commodity prices. You would have come across various news channel talking about say the rainfall is below normal. So as we speak, like till 15th August, the deviation is 4.5% than the long-term averages. It's having implication for say acreages which the farmers will be doing in this particular season. So if we think about say overall say acreages, it's close to 1% YY up, but with the normal scenario, it's close to 7% down. If we think about say demand scenario perspective, then in last 4 quarters, probably the rural was bringing it down. But if we are looking the Nielsen number, then FMCG it looks like the rural is also coming back slowly but steadily. And if that is the case, then probably in the coming quarters, the volume growth should revive. Uh, Urban was relatively more resilient, probably getting some support from some modern trade and say e-commerce. Net, it appears that volume growth should start inching up, which were relatively muted in past 5, 6 quarters over there. So staple is still a long way to go, but discretionary is doing relatively much better, whether it's a four-wheeler, two-wheeler, and even for say airline passengers number. So it may appear that the overall airline passengers count is quite close to where it used to be in the pre-COVID scenario, like close to 132 lakh crore monthly number, vis-a-vis say 130 lakh crore, 130 lakh monthly number in the pre-COVID scenario. But think from the perspective, interim, a lot of hike had already happened in case of the airfare, but still these numbers are there, which suggests that the sector character has changed. There's a lot of discretionary demand, travel is happening, and which is a good news from the overall discretionary spending perspective. Monthly retail credit growth had been quite strong, like on YoY basis, it remained 20% plus, which suggests personal loan, etc., is doing quite well. If we think about, say, capex, so capex spends remain the elevators supporting the overall domestic growth. Like as I already mentioned, that cement sales growth had been almost 9% up on YY basis. So is the case with the IIP Capital Goods Index and IIP Infrastructure Index. So capex having positive impact on the overall infrastructure spending and so on. And capex is having a multiplier effect, which should be a good, which is actually quite a good news for the overall economy growth perspective. So CPI, you would have seen there had been recent surge in the CPI number. It had more to do with, say, vegetable prices moving up significantly up. You will recall that some of the QSR players would have taken out the tomato from their menu for the reason that it became 200 rupees a kg. And it's having a significant upward, adverse impact on the CPI inflation figure. If we exclude the vegetables, CPI inflation was relatively more tolerable, like close to 5%, and so is the case with the core CPI. The surge in the vegetable prices is more transitory in nature. We have already seen that many vegetable prices have already come down. So in the coming months, that CPI should also come within the relatively more tolerable range, and which should be a relatively positive news. So net, we believe that if we just exclude a couple of months and think, say, quarter perspective or year perspective, CPI should be within the say tolerable range for the RBI, and if that would be the case, then probably we are quite close to the peak of the interest rate cycle, at least in India. Export related sector, there had been some challenges like global demand and there had been some issues related to the BFSI sector globally, and that's the reason you are seeing that the IT revenue growth had come down. It's close to 8% YY in FY23, vis-a-vis double-digit growth in FY22. If we think about, say, flows in the overall equity market, so last 6 months, it is the positive, say, development over there. So it's quite reverse the situation what probably we were observing from October 21, like foreign portfolio investors were withdrawing the money from the country, and that's the reason we have seen that despite there had been decent earning growth at the index level and quite strong earning growth for most of the growth companies, it was not translating into the good stock return. Because what happens that if somebody is pulling out money, it's having implication for the multiples. And at times, despite having a good earning growth, it does not translate into the stock return. But when the reverse process happens, then the appreciation for that earning growth do come into the picture. So FPI picture is changing. As far as the domestic flows are being concerned, they had been quite resilient across last 2-3 years. They are only inching up and providing support for the overall equity market. This is the snapshot of last 30 years. It suggests that for stock market to perform, earning growth is the first and the foremost requirement. At the same time, at times they are the lead and lag. sometimes earning growth come and the returns are being followed. Similar situation is going on as we speak, like earning growth had been close to 19% CAGR in last 4 years, but the price performance CAGR was only 11%. And whenever this sort of thing happen, it's having implication for the valuation. Like at the Nifty valuation level, now the valuation number look quite benign, or I would say quite reasonable. Like it's quite close to say 10-year average. Ideally, it should be higher because the composition of the Nifty itself has changed in favor of the sector which traditionally command relatively higher multiple, like banking, NBFC, consumer sector, which command relatively higher multiple, have started gaining more and more weight in last 5-6 years. So theoretically, the say last year average may not be the right yardstick, or theoretically the valuation multiple may be slightly higher than the same. Net, even if the multiple remain where they are, the figure suggests that probably in time to come, the earning growth should translate into the decent stock return. So if we look last 4-5 years, the earning growth was coming at reasonable pace, and it should be the case even for next couple of years at least. If we think about India Vision portfolio, so one thing which had been there all across the time frame, that was the earning growth. Like at the portfolio level, portfolio companies combined would have delivered close to 22% earning CAGR, with a 16% earning growth for the Nifty. Q1 FY24, so sales growth in the BSE 500 slowed down to 5%. It had some linkages with the global commodity prices, and slowdown was more pronounced in the globally linked sector like chemical, IT, metals, and followed by low ticket consumption items. Whereas the high end consumption and the capex continued to do well. Margin expansion had been relatively better, like while the top line slowed, OP growth for the BSE 500, excluding the commodities and BFSI, accelerated to 22%. If we think about say sectoral trends, so banks picture perfect was delivery was quite strong, and it had more to do with that loan growth, credit growth had been quite decent, and the credit cost was quite relatively lower. In the consumption side, as I already mentioned, that though the top lines of growth had slowed down, but the margins expanded, which provide some support for the overall earning delivery. Export related sector, whether IT and chemicals, they had a relatively softer quarter, while the pharma and auto export did relatively better. In terms of the commodities, OMCs reported very strong growth, while metals and the downstream companies reported weaker performance. So net, it was a mixed bag, and we believe that things are stabilizing, getting steady, and in next 6 months or so, the consumption should also coming back quite strongly when the rural start getting the stabilization, driven by say better incomes led by the higher hike in the MSP prices. So this is a summary of the Q1 FY24 performance. Like India Vision portfolio would have delivered 20% plus top line growth, 22% OP growth, and 23% plus PAT growth in Q1 FY24. If we think FY24 and FY25, we expect the portfolio should deliver 23% earning growth, vis-a-vis say 13% earning growth for the Nifty in FY24. Next year, our expectation is almost 25% earning growth, vis-a-vis 15% earning growth in the Nifty. So earning growth had been there, and continue should be the case in time to come. Psychographic of the portfolio. So we are overweight on financial, consumption, and the manufacturing. So financial is almost 1/3 of the portfolio. Consumption is about 25%. In the consumption, we have tried to cover, say, retail, staples, beverages, building products, and they are doing relatively quite well. Manufacturing is another area where we are having significant overweight position. Chemical were pulling it down, but we do believe that it's more of a matter of quarters when the current concern, whether related to demand or say supply chain destocking, it should be well taken care of, and they should also come back. Auto ancillary is doing relatively better, and so is the case reflected in the say operating performance for company like Sona over there. Overall, as I already mentioned, that we expect FY24-25 quite a strong earning growth. Our companies are having return on capital employed more than 30%. So cash generating companies, and as I already discussed, that from the valuation perspective, probably we are quite close to where the valuation trough happened in last 4 or 5 years. So you will recall that in March 20, when the COVID happened, that valuation contraction happened for the portfolio as well. Same had been the case in June 21, when say COVID 2, and then again during the time of say Russia-Ukraine war. But it was quite close to say 40p trailing basis, and as we speak, we are not far away from the bottom, and I would say still lower than the say averages being seen in last 4 or 5 years. Net net, it appears with the case that scope for the further valuation derating looks lower. And in that scenario, if the earning growth is quite strong, then decent part of that earning growth should convert into the stock return as well. This chart also shows one thing, that in last 1 year, or I would say October 21 till March 23, there had been significant derating, and you will appreciate that stock return or say portfolio return a combination of two things, like earning growth and what's happening to the multiple. So last year, the earning growth had been 20% plus, but derating was so sharp that the return was quite muted. But now the multiples have come down to the level where we will say that they are quite close to the trough being experienced. If that is the situation, then in coming years, there should be a decent conversion of the earning growth into the stock return. So this is the picture, say, in last 1 year, 2 year, and 3 year. So things are coming back in last 6 months or so, though we have yet to cover some ground, what is being lost in CY22. So this particular portfolio is quite similar to the another strategy we follow, like India 2025. So if we look, say, performance till CY21, the portfolio was delivering close to 21% CAGR with a 18% CAGR, say BSE 500. CY22 was a difficult year where and it was more specific to for matter of choice, like we are focused in an area which is high quality, high growth. And in last, in CY22, that was an area which got a lot of beating because of higher interest rate leading to high demand of say equity risk premium and so on. But the recovery is happening, like CY23 till date. The portfolio is already up close to 15%, vis-a-vis say benchmark, say close to 10%. So we have covered part of the lost ground, and we believe that if the on-ground fundamental performance remain good, then in time to come, we should do relatively better. These are some of the stock which have done well in last 3 months or last 1 year, like Polycab, APL, Apollo, Astral, Chola has done relatively better. There had been 3-4 stock which were dragging the overall performance, like I already mentioned about the case of Naveen and SRF, which had more to do with the industry-wide issue, like chemical as a sector was taking beating because of say slowdown in the demand as well as say supply chain destocking. But our strong view is that it's more of a issue of the near term. Otherwise, from say 3 to 5 year perspective, this sector has to deliver relatively quite a strong earning growth. And again, even in this sector, we believe that in coming quarter, both operating performance and the stock performance should look relatively better. So from market outlook perspective, we expect that the monsoon has been relatively erratic. And that's the reason it's having impact on the sowing patterns and the kind of volatility we have seen in the fruit and vegetable output. But it's more transitory in nature, and it should be taken care of in next 2-3 months. It's already visible that most of the vegetable prices are coming down. And if we think about the crop perspective, as I have already shown, that overall output is marginally positive, and this additional support driven by say government hike in the MSP, which should lead to relatively better say experience for say rural income and good news for the overall rural demand as well. I have spoken about the food inflation part, but again, it's turning downward and probably in the comfortable range in coming months. So if we think about export-led growth, there was some pressure in the first half of FY24, and probably this destocking related issue should be taken care of in Q3 or Q4 onwards. So I will stop over here. If any query, then happy to answer the same.
Thank you so much, Kuldeep. So there are number of questions already have come. Let me just collate and structure them for ease of understanding. The first question is from the core theme of the portfolio. In India Vision, we speak about the value migration theme from the public to private sector bank, unorganized to organized. So do you think the opportunity in this space is going to increase further?
So first of all, what's a value migration? Value migration is that there are certain sectors which should do better than others because they have some sectoral tailwinds, whether it's a demographic or say increase in income level and so on. It may be driven by that we have better alternative in time to come. So it's more of a structural direction. If you think a scenario like 25 years back, it was more about say banking with the PSU bank because we did not have that many alternatives. But now private banks are going to tier 3, tier 4 cities. At the same time, the urbanization is also helping that consumers are moving towards the cities. So net, the reach has increased for these private banks and NBFCs. And that's the reason the better run, whether banks or NBFCs should do relatively better. So it's a one-way journey which is happening. And same is the case with many other sectors, like when we say unorganized to organized transition, it's bound to happen because when you have the say aspiration, you want to have better lifestyle, and when the incomes are rising, probably you can support your aspiration. So whether the companies are trying to reach to the doors of the consumer or vice versa, it's again a one-way journey. So we believe that there are few areas, whether it's a consumption, financials, they should do quite well in an economy like India, which is emerging, say, market and role model for many other economies globally. Like we say, probably it's India's century rather than just saying it's India's decade. If that is a situation that India is doing well, then obviously there are certain sectors we should do even better. So in value migration, we just try to figure out which are those sectors, like 4 or 5 themes are there. Traditional themes are like consumption, financial. In post-COVID scenario, the new emerging areas are like make in India, manufacturing, capex. Then there is another area which is getting traction like chemical. If you think from a situation like whether it's a China plus one, Europe plus one, the sectoral say tailwinds are available in the chemical sector. And another sector would say more tech-oriented, digitization related sector. So these are the sectors which should do well, should offer relatively higher growth. And that is a theme we do believe it's a structural theme for a country like India. And there will be more and more opportunities coming our way.
Thank you, Kuldeep. So I'll again request the participants to feed in their queries if you have any query. So the next question which has come, the chemical sector has been under pressure on the back of the subdued global, right? Global demand and inventory destocking. So which has impacted the volume growth. So how do you think this sector will revive in the coming days?
So as I already mentioned about this particular aspect, that there had been two issues. One was related to end user demand. Second was more related to the channel destocking. So we do believe this channel destocking is probably coming quite close to a level from where the worsening should not happen. In fact, the revival should happen. That's the reason we believe that in coming quarters, the destocking related issue should be the issue of past. And in FY25 or onwards, we are quite positive about sector because world is looking for alternative, and reasons may be anything like whether alternative for China or that say local operating issues related to in Europe. Net, the opportunity is quite huge and we are relatively smaller. Like in the specialty chemical sector, we are only 3 to 4% of the overall market. Whereas if you combine, say, China and Europe, they are close to 40% plus. So even if a marginal shift happened from those two geographies to India, we are talking about significant expansion in the overall opportunity size. So while short-term pain is there, but net that pain will further provide the tailwinds to this particular sector. And this is quite visible that the people are signing long-term contracts, putting the capex, and probably the benefit of that capex should come in the coming years.
Thank you. An interesting question. Selecting consistent performers in disruptive times is the success formula for long-term wealth creation. So, can you name such performers and disruptive names which might help in creating a long-term wealth?
So, think a situation like a pre-COVID scenario. Whenever we thought about compounding, probably it was just limited to a couple of sectors like consumption and financial. And I would say COVID was boon in disguise. Like all it said, and there was a focus that we should have self-reliance. It does require manufacturing. It does require that how we approach different aspects. And COVID provided an opportunity that there is a thrust that we should think about, say, local manufacturing, local infrastructure, and so on. And that's the reason the company like APL Apollo came into the picture in September 20 or so. It has done quite well and probably should continue to do well even for years to come. The same is the case with, again, the Polycap, like where we entered last year. So when we think about, say, the development which are happening in our country, so both residential capex as well as, say, industrial capex is on the upswing. Polycab is having 30% exposure or 30% revenue coming from, say, residential capex, primarily the wires, and balance coming from the cables. Both the sectors are doing quite well. And probably it's not 1 year scenario. We are talking about for many years to come the similar situation. And it's not restricted to India. Now the export opportunities are coming for not so export oriented sector. Like earlier, export was quite limited to IT, pharma, chemical, and so on. Today, the export is also providing an opportunity for cable and wire sector. Like for Polycab, the export has already become 10% of sale, and there's huge demand for that particular area. So this is another emerging area. Third, if you think about, say, lifestyle changes, there are the company which should benefit from this trend, like Radico Khitan. So we are just trying to use any opportunity coming our way, even if it's coming in the distress scenario. Like a couple of examples I have given in last 2-3 years, where the overall economic environment was relatively more challenging. Like 2020, it was more about COVID year. Last year, it was more about Russia-Ukraine war. So some bottom-up idea do crop up, and which can have the structural tailwind. We just try to figure out where the lasting impact would be there and try to incorporate those changes in our portfolio.
Thank you. So there are a couple of questions which have come in terms of performance. So in recent past, I'm clubbing both the questions together. In recent past, we have observed there has been sharp uptick in performance metrics. If you can kindly highlight the top contributors of the same. And the second part is subsequently, if you can highlight the gap which has been created in the portfolio since inception with respect to the benchmark, and how are we going to bridge the same?
So if we think about, say, portfolio companies perspective, what we expect from them, we expect the company should deliver strong earning growth on the ongoing basis. So as I would have shown, like our portfolio companies put together almost 22% earning growth for 5 years from CAGR perspective, vis-a-vis, say, benchmark. So earning growth alpha had been always here. It had been there in past, it had been there in last year, and probably it should continue for years to come. At the same time, second part I mentioned that there are times when the concerns are around, and it may be global concern, it may be somebody withdrawing the money in the areas where your portfolio is placed, like high quality, high growth, then probably that earning growth do not get enough appreciation. So this is something what happened in FY23. Despite having quite a strong earning growth, multiple derating was so sharp that overall stock return was quite muted. Third point I made, now post derating, valuation has already reached to the level which probably were quite low or the lowest being experienced in last 4 5 years. If that is a case, then the probability of it going further down is relatively lower. I am still saying some probability is there. This is how the stock market behave, but the probability is relatively lower. If that is the case, then as long as we believe that the earning growth is going to be resilient, sooner or later the conversion of the same has to happen in the stock return. As I was mentioning earlier, that despite having earning growth, local flows, etc., things were not working out because FPIs were pulling out big sums and they can sell what they own. They own the same high quality, high growth thing which we own, and they were the net seller of those companies. As I mentioned, in last 6 months, they are coming back. So these companies were doing what they have done in past or last year, or they know what to deliver in terms of earning. It's all about the appreciation of that earning. It has started happening in last 6 months and probably should continue in years to come.
Thank you. So now the questions have come directly from the stocks. We have seen Infosys performance in the last couple of years not been great. Are we thinking of taking any action on it?
So any forward-looking action difficult to comment. If you think about the sector, we have less than 4% weight in that particular area, which if it's a benchmark, there is almost 10% in the IT index. So as you can say, software services, we have 3.6% exposure, which is say 10% in the benchmark. So we are always underweight on the IT sector for one simple reason that growth is likely to be relatively lower. Okay, and there will be phases when probably it exceeds the normal growth, and there are the phases when it is below normal. So during COVID time, the growth was relatively higher than the say normal growth trajectory of high single digit or low double digit, and in FY24 it should be relatively lower. Net net, if you think about say 3 to 5 year perspective, the IT companies or IT sector overall should ideally deliver say high single digit sort of top line growth, and at the bottom line the earning delivery should be low double digit. Barring growth, this particular sector many other boxes like high cash flow generation, dividend distribution, so many good aspects. Only challenging area is the growth part. So we have some exposure in the IT. At the same time, it's a significant underweight position as far as the sector is being concerned. As far as if you think about Infosys, we know that it's a global slowdown situation over there because they are quite dependent on how the global growth is panning out. So that's the reason Infosys had cut the overall year guidance, which led to some negative reaction on the stock part. But again, as I mentioned, there are years which are better than average. There are years which are below average. So probably FY24 from earning growth will be relatively below par. But FY25 onwards, again, low double digit earning return should come over there.
Thanks, Kuldeep. So again, queries on stocks. Your views on Page and SRF and their reason for underperformance.
So SRF is again related to more sectoral issue, as I mentioned, whether it's end user demand or supply chain destocking, having implication for almost every player in the chemical sector. The question is whether it's a say temporary issue or it's a permanent. We believe the company is putting a lot of capex which should drive the future growth. So it's probably a blip in the overall growth story. Like FY24, we believe like flat revenue growth in combination with some margin compression should lead to say earning growth decline, marginal earning growth decline. But again, if we think about 25 onwards, we believe this particular sector can deliver again 20% plus, or this company can deliver again 20% plus earning growth. So It's more like it's a pause in the overall story as we speak. As far as the page is being concerned, so two things had been there. One is the overall demand weakness. Second was that company was putting in place its own ARS system, like automatic replenish system. And whenever it happens, then it's having implication on the primarily reported numbers. So first half or second half FY23 impacted because of that ARS implementation. And there was some impact in Q1 FY24 as well. We believe that all these things are good from the long term perspective because they are trying to optimize the overall supply chain, and the positives of the same should be visible either in coming quarters and the coming years. We have a strong belief that the companies and this particular company should start delivering quite a strong number from Q3 about 24 onwards.
Thank you. This would be probably the last question. So I'll again request, if you have any queries, please put in your questions in the chat box. So the last question would be like, how are you going to position this portfolio and your outlook for financial year 24, the portfolio's outlook?
So as portfolio psychography is quite visible, so we are quite positive on the financial sector, manufacturing sector, and the consumption. So these are the overweight area and should continue to do well, not only for about 24, in fact, for many years to come. And as I have already mentioned, that despite having some hiccup across some of the companies, net we expect more than 20% earning growth even at the portfolio level, and same should continue for even about 25 as well. So I mentioned there had been some challenges in certain pockets. One of them was like chemical, where the pain should be largely over in the second half FY 24. And in the staple sector, where the growth challenges had been there in last 4-5 quarters, it should also get addressed when the rural start coming back. So overall, from earning growth perspective, we had been relatively quite confident that it had been there even in the challenging time. Like last 5 years, there had been one challenge or another, but still these companies were delivering earning growth. So when we think about relatively stable scenario, this this momentum should not stop. Like this earning growth momentum should not stop. And if it's happening, then we are relatively quite confident that there should be decent conversion of the same into the stock return as well.
Thank you. One more question has come. Your view to hold Aarti Pharma?
So Aarti Pharma, we got through demerger, and it's not say any portfolio holding. Probably we will exit some point.
Okay. And why there is cash holding of 4 to 5% in the portfolio?
No, it's only 2 to 3%.
Okay. I don't think there are any more questions. So thank you so much. Thank you, participants, and thank you, Kuldeep, for your time.
Thanks, everyone. Have a good evening.